Tonight, we are moving to a new topic. We shall be looking at foreign currency risk management. Our topic tonight, foreign exchange risk management. This topic is by design of your syllabus. It's an environment you can expect 20 marks question from. Risk management is an aspect of the syllabus that you can deliberately prepare with an expectation of getting a 20 marks question. This topic, we try to discuss how we can manage foreign currency or foreign exchange risk. We have the foreign currency markets. Just like you have the stock markets, where investors can buy or sell stock. We have the bond markets, where investors can buy and sell bond. We have the option markets, where investors can buy and sell options. Tonight, we shall be discussing the foreign currency market. What is foreign currency market? A foreign currency market is a market where investors or market participants can buy or sell foreign currency. A foreign currency market, a market where participants transact on foreign currency. At this market, we have banks, we have currency dealers, we have corporate companies, and we have individuals that can buy or sell foreign currency at a price known as the exchange rates. To buy or sell foreign currency, there must be an exchange rate at which one currency will be converted to another currency. If you want to buy dollar, we need to determine how many naira do you require. What is the exchange rate between naira and dollar? So the first question is, what is exchange rates? The first question to be addressed. All right. We are looking at foreign currency, foreign exchange, risk management. We are looking at foreign exchange, risk management. All right, let's go on with the class. So the first question to be addressed, what is exchange rates? You can define exchange rates as the number of units of one country currency that can buy 1 unit of another country currency. I'll take that again. Exchange rate. We can define exchange rates as the number of units of a country currency that can exchange for 1 unit of another country currency. The exchange rates sorry for that, please. The exchange rates can be stated directly or indirectly. Your exchange rates can be quoted either direct or indirect. Direct quotes. A direct quote is a situation where the exchange rate is expressed or stated in terms of the number of units, of domestic currency that can purchase 1 unit of foreign currency. Direct quotation. Direct quote is a situation where the exchange rate is stated in terms of the number of units of domestic currency needed to buy 1 unit of foreign currency. For example, let me expand this, please. For example, 350 naira to $1. Number of unit of naira that can exchange for 1 unit of dollar. That is direct quote, whereby the exchange rate is stated in terms of the number of units of the domestic currency that can buy 1 unit of foreign currency. If you say 1,750 naira to $1, the quantity of naira needed to buy $1, that is direct quotation. You can have something like this. In just 1 minute. You can have something like this. 1,650 naira per dollar. The number of units of domestic currency that can exchange for 1 unit of foreign currency. This is called direct quote. Naira is domestic currency. Dollar is a foreign currency. In this case, we have a direct quote. Number 2, indirect quote. Indirect quote is a situation where the exchange rate is stated in terms of the number of units of foreign currency that can exchange for 1 unit of domestic currency. For example, look at this. Dollar, $0.0625 per naira. The number of units of foreign currency that can exchange for 1 unit of domestic currency, that is indirect quote. Please note, relationship between direct and indirect quote is reciprocal. That is, you can calculate indirect quotes as 1 over direct quotes, or you can calculate direct quotes as 1 over indirect quotes. It's a reciprocal relationship. We have defined exchange rates. We have explained exchange rate quotation, direct quotation, or indirect quotation. Our next explanation. The rules for the buying and selling of foreign currencies. Rules that guide buying and selling of foreign currency. Rule number 1, exchange rates are quoted from the viewpoint of the bank or the authorized dealer. Exchange rates are quoted in favor of the bank or the authorized dealer. That is point number 1 to be noted. Point number 2, when the customer buys currency, the bank will sell. When the customer is willing to buy foreign currency, the bank will sell foreign currency. And when the customer is willing to sell foreign currency, the bank will buy foreign currency. What that means is that there must be a buyer and seller. You must identify the buyer and the seller. Rule number 3, for direct quotes, in a direct quote, the bank buys at lower rates, at a low rate, and sell at higher rates. If you are giving a direct quote, bank will buy at the lower rates and sell at the higher rates. In an indirect quote, if you are giving an indirect quote, bank buys at higher rates and sell at lower rates. Deliberately, I'm trying to keep the pace of the class because you cannot address questions unless you understand the principle. You cannot address question on hedging unless you understand the principle. Please, you are going to memorize these rules because if you are dealing with question on currency, foreign currency, it is either you are buying foreign currency or you are selling foreign currency. All right. Our next explanation, terms and terminologies associated with foreign currencies. 1, spot rate, spot exchange rate. The spot rate is the rate, is the exchange rate for immediate foreign transaction. the spot rate. The spot rate is the exchange rate for immediate foreign transaction. For example, if you are buying dollar now, the exchange rate that applies now is known as the spot exchange rate. Or if you are selling dollar now, if you plan to sell dollar today, that exchange rate that applies today is known as spot exchange rate. Number next, forward rate. Forward exchange rate is the exchange rate between two currencies agreed now. Exchange rate between two currencies that is agreed now for future foreign transaction. Forward exchange rate. Exchange rate between two currencies that is agreed now, but for a transaction that will happen at a future specified date. The forward rates are often quoted as a discount or premium to the spot rates. The forward rates are usually quoted as a discount or as a premium to the spot exchange rates. Where the forward rate is higher than the spot rate. If the forward rate is higher than the spot rate, this implies that the spot rate is quoted at a premium forward. If your forward rate is greater than your spot rate, it implies that the spot rate is quoted at a premium forward. Alternatively, if the forward rate is lesser than the spot rate, this implies that the spot rate is quoted at a discount forward. All right. Your forward rate is the exchange rate for transaction that will happen at a future specified date. Number next, cross rate. What is cross rate? This is the implied exchange rate. Cross rate is the implied exchange rate between two currencies based upon the explicit relationship with a third currency. Cross rates. Cross rates is an exchange rate between two currencies based upon explicit relationship with a third currency. We are going to illustrate this. We need to illustrate this. Our cross rates. Look at the illustration. I'm trying to create space. Let us illustrate this briefly. Look at this triangle. Naira to dollar. Yen to dollar. Assuming we have 1,500 equal to $1, and you have 100 yen equal to $1. There's relationship between Naira and dollar. There's relationship between yen and dollar. But there's no relationship between Naira and yen. We said cross rates. Cross rates is the exchange rate between two currencies. Say Naira and yen. Based upon the explicit relationship with the third currency, dollar. Look at this, please. Naira to dollar, 1,500. Yen to dollar, 100. What is Naira to yen? Question mark. There's no direct relationship between Naira currency and Japanese yen. But we can use relationship between naira and dollar and Japanese yen and dollar to derive relationship between naira and yen. That is the cross rate. Cross rates, exchange rates between two currencies, implied exchange rate between two currencies based upon the explicit relationship with the third currency. In this case, if I want to get naira to yen, I'll just divide. That means 15 naira equal 1 Japanese yen based on cross rates. That means 15 naira we exchange for 1 Japanese yen. That is the cross rate. I'm trying to check my message. Okay, yes, we are dealing with hedging. All right. Please take note of the explanation. Theories of exchange rate determination. What are the theories of exchange rate determination? The question we are trying to address here is, okay, Charity.
Good evening, sir.
You are welcome, ma'am.
Sir, before you move into theories of exchange rate determination, please, I want you to go back to the triangle where there is a relationship between naira and dollar and relationship between dollar and yen. So you said assume that naira to dollar is 1.5 and yen to dollar is 100. What is naira to yen? No, I do not get the explanation.
Okay.
Thank you, sir.
Or you didn't get the computation?
Yes.
Okay. Assuming 1,500 naira can exchange for $1 and 100 yen can exchange for $1. Look at it now. We said cross rates. The implied exchange rates between two currencies, naira and yen, based upon the explicit relationship with the third currency, dollar. There's a relationship between naira and dollar. There's a relationship between Japanese yen and dollar. We now want to get naira to yen. How many naira do I require to purchase one Japanese yen. There is no direct relationship between Nigerian naira and Japanese yen, but we can use relationship with dollar to derive relationship between naira and Japanese yen under cross rates. Look at it, please. Naira to dollar is equal to 1,500. Yen to dollar is equal to 100. What is naira to yen? Question mark. How many naira do I require to buy one Japanese yen? You now do division. 1,500 naira divided by 100 yen. Divide this. That means I require 15 naira to buy one Japanese yen. That is cross rates. Is that better, ma'am?
Yes, I get it so well now. Thank you so much, sir.
All right. Theories of exchange rate determination. What we are trying to discuss here is how do companies determine exchange rates? How do you determine that 1,500 naira should buy $1? Why is it that 1 naira is not equal to $1? Shebi just one currency, one paper naira, one paper dollar. What makes dollar to be stronger? Why is it that I require 1,500 naira just to buy $1? How do countries determine exchange rates? This is the question we are trying to explain here now. There are two major theories that explain exchange rate determination. There are two major theories that explain exchange rate determination. Number one, interest rate parity theory. The interest rate parity theory. This theory states that the differences in exchange rates, the differences in exchange rates between two currencies occurs as a result of differences in interest rates. I'll take that again. The interest rate parity theory states that the differences in exchange rates between two country currencies. Two country currencies occurs as a result of differences in interest rates between the two countries. According to this theory, a country with higher interest rates, a country with higher interest rates, we have its currency depreciating faster. A country with higher interest rates, we have its currency value depreciating faster compared to a country with lower interest rates. A country with higher interest rates, we have its currency value depreciating faster compared to a country with lower interest rates. For example, if interest rate in Nigeria is, look at the example, assuming interest rate in Nigeria, interest rate in Nigeria is 25%. Interest rate in US is 3%. Naira will depreciate by 22% against dollar. Difference 25 minus 3, 22%. One of the reasons why Naira is falling is because interest rate in Nigeria is very high. If you go online now, check online. What is the interest rate in Nigeria? Now check the interest rate in Ghana, or check the interest rate in US. The reason why you have differences in currencies, currency exchange rates, according to this theory, the reason why we have differences in currency exchange rates is because of differences in interest rates between countries. Assuming interest rate in Nigeria is the same as interest rate in US, 1 Naira will equal to $1. Given this explanation, this theory says that if you know the interest rates, if interest rates are known, if interest rates are known between two currencies, and you are given the spot exchange rates, if interest rates are known between two currencies, we know the interest rate in Nigeria, we know the interest rates in US, and we are given the spot exchange rate, then we can forecast forward exchange rates using the interest rate parity theory. We can forecast the forward exchange rate with the equation below. Look at below, please. You can use interest rate parity theory to forecast exchange rates between two currencies, provided you are given the spot rates and you know the interest rates between the two currencies. Look at the equation. For direct quotes, the equation is 1 plus FIR divided by 1 plus DIR is equal to S over F. For indirect quotes, the formula will change slightly. 1 plus FIR over 1 plus DIR is equal to F over X, where your FIR, foreign interest rates per time period, your DIR, domestic interest rates per time period, your capital letter F, that is the forward exchange rate. Your capital letter X is the spot exchange rate. We can use this equation to forecast exchange rates between two currencies. So please note, one of the reasons why...
Sorry, sir. Please, can you take the formula again?
All right, no problem. One of the reasons why Naira value is falling is because Nigeria interest rate is very high. All right, look at the formula again, or the equation rather. Look at this, sir. For direct quotes, the formula is 1 plus FIR over 1 plus DIR is equal to X over F. This is the formula if you are giving direct quotation. If the exchange rate is quoted directly, your FIR, foreign interest rates, your DIR, domestic interest rates, your capital letter F, forward rates, your letter X, spot rates. When you say foreign interest rates in foreign country, like if I'm comparing Nigeria and US, Nigeria is a domestic currency. Naira is a domestic currency. So exchange rate in Naira, that is domestic, sorry, interest rate in Naira, that is domestic interest rate. Interest rate in dollar, that is foreign interest rate. For indirect quotes, this is for direct quotes. For indirect quotes, the equation will change. 1 plus FIR divided by 1 plus DIR is equal to F over X. Oh, excuse me, please. I hope that is better, Mr. Ajayi.
Yes, sir, it is.
Number 2, purchasing power parity theory. This theory states that the exchange rate between two currencies depends on the relative inflation rates within the respective country. This theory states that the exchange rates between two currencies depends on the relative inflation rates within the respective countries. According to this theory, the differences in exchange rates between two country currencies, the differences in exchange rates between two country currencies occur as a result of differences in inflation rates between the two countries. If inflation rate is higher in a country with higher inflation rates, we have its currency value depreciating faster. A country with higher inflation rates, we have its currency value depreciating faster compared to a country with lower inflation rates. If you check online, what is the inflation rate in Nigeria? What is the inflation rate in US? Assuming excuse me, please. Assuming inflation rate in Nigeria is Inflation in Nigeria. In Nigeria, 27%. Inflation rate in US, 2%. Naira will depreciate in value. That inflation rate will affect Naira value negatively. What this means is that the difference, 25%. Naira will depreciate by 25% against dollar. Because of differences in inflation rates. A country with higher inflation rates, we have its currency value depreciating faster. Compared to a country with lower inflation rates. With this theory, if you are giving the spot rates, and we know the inflation rate between the two countries, then you can estimate forward rates with the equation below. Look at below. For direct quotes, the equation is 1 plus Fi divided by 1 plus Di is equal to S over F. For indirect quotes, the formula is 1 plus Fi divided by 1 plus Di is equal to F over X. We can use purchasing power parity theory to estimate our future or forward exchange rates. Our next discussion. So please don't forget, the fluctuation in exchange rates is as a result of fluctuation in inflation rates. Our next discussion, foreign currency risk. Foreign currency risk. Foreign currency risk concerns the risk of adverse movement in exchange rates. Foreign currency risk is the risk of adverse movement in exchange rates. All right. This risk, the foreign currency risk, faces exporter who invoice in foreign currency. The foreign currency risk faces an exporter who invoice in naira, in foreign currency. An exporter that invoice in foreign currency, or importers who pay in foreign currency. This foreign currency risk is what we refer to as fluctuation in exchange rates, volatility in exchange rates. This risk can be classified into three. Foreign currency risk can be classified into three. One, translation risk or exposure. Economic risk or economic exposure. And number three, transaction risk. We start with the first one. Transaction risk first. What is transaction risk? Transaction risk is the foreign exchange risk arises in transactions between two parties. Transaction risk, risk resulting from foreign exchange fluctuation, foreign exchange volatility, involving transactions between two parties where the normal transaction currency of each party is different, where the normal transaction currency of the two countries is different. And when the transaction involves future receipts or future payments, so when you say transaction risk, risk resulting from foreign exchange fluctuation arising on transaction between two parties whose normal transaction currency is different. And when the transaction involves future receipts or payments. In summary, transaction risk arises as a result of timing difference between when a foreign transaction is entered into and when the actual settlement is done. The differences between or we say transaction risk that occurs because of timing differences in the timing between when a foreign transaction is entered into and when the actual settlement is effected. That gives rise to transaction risk. That gives rise to transaction risk. What kind of joke is this? Let's go on. We are discussing SFM. We are not discussing. We are not discussing every year. So I don't know this joke. Anytime you put comment on the chat, I will be forced to look at the comments. But really, ability to earn a genuine income, ability to earn your income genuinely, ability to go out and work genuinely, getting the appropriate skills to be able to earn income is an heavenly matter. So this SFM is an heavenly matter. All right. Illustration. For example, assuming our company based in Nigeria. So, Charity, let me illustrate this. Let me illustrate transaction risk. Our company based in Nigeria. Let me create small space. Our company based in Nigeria, XYZ PSC. Imports raw material from China. We have gotten raw material from China. Today is 16 September. The raw material was this raw material was $50 million US. We have purchased raw material from our supplier in China. They are worth $50 million. And we are required to pay back in 3 months' time. Our supplier has supplied the goods to us. And we are giving 3 months grace period to make payment. That means we are going to make payments in 3 months. 3 months time. That's like December 16. Transaction risk. Risk from foreign currency fluctuation. The risk arising from exchange rate fluctuation as a result of timing difference between when a foreign transaction is entered into. We enter into transaction today, 16th of September. We are to pay $50,000, $50 million in December 16. Because of the differences in time, assuming you are making your payment today, assuming you are going to pay the dollar today, we can determine the exchange rate today. But you are going to make the payments in 3 months' time. What the exchange rate will be between Naira and dollar in 3 months' time, we are not sure. That gives rise to transaction risk. The amounts paid in Naira amounts, the amount paid in Naira may be higher or lower in 3 months' time due to exchange rate fluctuation. Number 2, translation risk, also known as translation exposure. Translation risk. Yes, Charity. Speak to me. Or speak to the class.
Sir,
Please go ahead, don't worry. I can always hear you.
Okay, we have talked about XYZ PLC that imports raw material from China and they are to pay in 3 months' time. Like when we want to estimate the transaction risk, are we going to use, you'd not tell us which one we're going to use, either the purchasing power. I've moved from there. No. So how do we estimate the transaction risk? That's the question.
Okay. We still have a lot to deal with. We are still coming to the extent. First, understand what is transaction risk. The estimation aspect is computation. And we have not computed. I'm not the one that will tell you whether to use purchasing power or to use interest rates parity. It's a function of what the question says. And we have not gotten to question. Is that clear, man? So, at least understand the principle first.
Yes, it's clear. But like in that question, what's that the like what do I say that is the transaction risk? I'm not talking about the estimation now.
Look at the risk involved now.
Okay, sir.
As of today,
Yes.
you imported goods from China. You are supposed to pay $50 million. But you are going to pay in 3 months' time. Now, are you sure of the exchange rate? Assuming you are paying today, we know the exchange rate between dollar and naira today. But you are going to pay in 3 months' time. Do you know the exchange rate between naira and dollar in 3 months' time? Can you predict the exchange rate between naira and dollar? Nobody is sure. Naira may depreciate or appreciate. Dollar may depreciate or appreciate. Because you are not sure, if you are making your payment in 3 months, you are not sure of the amount of naira you are going to require to buy dollar. That gives rise to risk. What we call risk is uncertainty. What we call risk is fluctuation. When you are not certain of what will happen in the future, that is risk. You are aware that the dollar amount is 50 million, but you in Nigeria, your currency is naira. Now the question is, how many naira do you require to be able to buy $50 million in 3 months' time? You are not sure. Assuming you are paying today, you can determine the naira amount needed to buy $50 million. But you are going to pay in 3 months. Your naira payment may be higher in 3 months or may be lower as a result of fluctuation in exchange. So what gave rise to transaction risk? Why we have transaction risk is because, one, the currencies of the two parties are not the same. Two, the transaction involve future transactions. Because it involves future transaction, we don't know what the exchange rate will be in the future. Because there's a timing difference. That's transactions. Is that better, please?
Yes, sir. I get it now.
Number two, translation risk or translation exposure. Translation risk arises in international companies or multinational companies with foreign subsidiaries. Translation risk, also known as translation exposure. arises in multinational companies with foreign subsidiaries. The income statement and statement of financial position will be denominated in the local currency of the subsidiaries. The income statement and the statement of financial position will be denominated in the local currency of the subsidiary. And on consolidation, there will be need to translate the currency of the subsidiary to that of the parent company. Let me take that again. Translation risk. This risk is peculiar to multinational with foreign subsidiary. This risk is peculiar to multinational with foreign subsidiary. At financial year end, the parent company of a multinational will be required to prepare consolidated financial statement covering the activities of all subsidiaries. In the process of converting the assets and liabilities of the foreign subsidiary denominated in local currency to the currency of the parent company, this can give rise to exchange loss or exchange gain. And that is what we refer to as accounting exposure. That is referred to as accounting exposure. Let us illustrate this. Look at Mobil Oil. Let's take Mobil Oil. With the parent company in US. The currency is dollar. Mobil Oil has investments in different countries. Foreign subsidiaries. We have Mobil Oil okay, I can use the arrow, no problem. We have Mobil Oil Nigeria with a currency of Naira. You have Mobil Oil Ghana with a currency of cedi. You have Mobil Oil South Africa with currency rand. At financial year end, the parent company will prepare consolidated statement of financial. Consolidated financial statement that covers the activities of all subsidiaries. That means asset and liability of Mobil Oil Nigeria denominated in naira will be converted to dollar. The asset and liability of Mobil Oil Ghana denominated in cedis will be converted to dollar. The asset and liability of Mobil Oil South Africa denominated in rand will be converted to dollar. In the process of converting these currencies to the currency of the parent company, that can give rise to exchange loss or exchange gain. And that is translation risk. That is translation risk. Number 3, economic risk. Economic risk is the risk resulting from exchange rate fluctuation. The risk resulting from exchange rate fluctuation that can affect the present value of future cash flows. It can affect the present value of future cash flows. It can also affect the international competitiveness of a company within a country. Economic risk can affect the ability of a company to compete internationally. This risk can also affect remittances from subsidiaries to the parent company. The risk can affect remittances from foreign subsidiaries to the parent company. Multinationals are highly exposed to economic risk. All right. We have discussed the various types of currency risk: transaction risk, translation risk, and economic risk. Our next discussion hedging currency risk. How can we hedge against currency risk? How can companies protect themselves against the risk of foreign currency fluctuation? Let's go to this. I've gone too far now. The hedging method, the method of protecting companies against the risk of exchange rate fluctuation, can be categorized into two. Hedging method can be categorized into two. One, we have the internal measures or internal techniques. Then you have external measures. Internal measures are referred to as non-financial measures. Under the internal measures, we have leading and lagging. Leading and lagging. To lead is to pay early, is to make payments early in a currency that is expected to increase in value against the payer's own currency, against the naira, against naira. We said leading means making payments early. While lagging means delaying payments to a later period. Both methods can be used to protect a company against currency fluctuation. The purpose of leading is to make payments early in currency that is expected to increase in value. While the purpose of lagging is to delay payments to a later period. You can use both methods co-hedge. Some of these things we do it unknowingly. If you are planning to travel in December, you can book your tickets now. The problem with this method is how to identify the movements of exchange rates. So you can do leading and lagging. Number 2, netting. Number 2 method, netting. Netting implies that when a company expects to have future cash receipts in foreign currency and future payments in the same currency, the receipts can be used your foreign receipts can be used to net off your foreign payments. Your expected foreign receipts can be used to offset your foreign payments, provided both transactions are in the same currency. You can do net off, netting off foreign receipts against foreign payments. The extent to which foreign receipts is used to repay foreign payments. The extent to which you can use your foreign receipts to offset, to net off your foreign payments. The extent to which your risk is eliminated. Yes, your question. Charity.
Sir, please take the definition of netting again.
Netting.
Yes, sir.
It's an English word. Netting of foreign receipts against foreign payments in the same currency denominated. For example, look at the example. My company based in Nigeria my company SYZ PSC. We have 3 months expected payments. $20,000, $20 million, or $30 million. We also have 3 months expected receipts. $40 million. Both transactions are in dollars. One transaction involves payments in dollar. The other is receipt in dollars. You are now going to net off $40 million minus 30. That is netting off. Net off. If you net this off, we are left with 10 million. The extent to which your foreign payments can offset your foreign liability. That shows the extent of foreign currency risk reduced. Next requirements. Next, we have invoice in home currency. To remove foreign currency risk. To remove foreign currency risk. You can decide to invoice, to quote your invoice in domestic currency. One way of removing foreign currency risk is to invoice in home currency, meaning that quote your invoice in your domestic currency. By so doing, we are going to eliminate foreign currency risk. You invoice in your domestic currency. For example, our company exported, or we exported goods to US. If you are sending your invoice to your customer in US, you are going to quote your selling price in Naira value. The total selling price of the products will be quoted in Naira. It is now left for the customer in US to look for Naira and pay you. Number 4, do nothing. Do nothing simply means that a company involved in international transaction, a company involved in international transaction can decide not to take any action to hedge. You can decide not to hedge. Don't take any action to hedge. It is believed that some transaction will result in exchange gain, while some will result in exchange loss. In this case, your exchange gain and exchange loss will cancel out. So there's no point when you say do nothing. There's no point for any company to hedge. If you are involved in foreign transaction, you can decide to do nothing. At some point, you are going to gain, you can make profits, exchange gain. At some point, you can incur losses. Your exchange gain will cancel out the exchange loss. Then lastly, we have matching. Lastly, under internal measures, we have matching. This is closely related to netting. Matching is closely related to netting. It involves matching the timing of foreign receipts with the timing of foreign payments. Matching. It involves matching the timing of the foreign receipts with the timing of the foreign payments. All right. We have discussed internal measures that can be used to hedge foreign currency fluctuation. We have leading and lagging. We have netting, invoice in home country. We have do nothing, and we have matching. Our next discussion, external measures. External measures are regarded as financial measures. The external measures are regarded as financial measures. Under the external measures, we use financial derivative products. Under the external measure, we have 5. We have the forward exchange rate. We have the forward exchange rate. It's also called forward market hedging. It's also called forward market hedging. What is forward exchange rate? A forward exchange rate is an agreement, a forward exchange contract, sorry. A forward exchange contract is an agreement between two parties. An agreement between two parties to buy or sell a specified amount of foreign currency. A specified amount of foreign currency at a fixed purchase price, at a fixed exchange rate, known as the forward rate. At a fixed exchange rate, known as the forward rate, on a particular future date. That is forward rate. Forward exchange contract. Your forward exchange contract. With forward contracts, a forward exchange contract is entered into now. A forward exchange contract is entered into now for settlement at an agreed future date. This implies that the company knows in advance how much money it will receive or paid. With forward contracts, the company can determine in advance how much naira to be paid or to be received. By using forward contract to hedge, you have removed uncertainty surrounding the interest rates. You have hedged, regardless of this spot rate in 3 months' time. You have hedged under a forward contract. Number 2, money market hedge. Number 2 method, money market hedge. What is money market hedge? Money market is an alternative to forward contracts. Money market is an alternative to forward contracts. In this market, company can borrow or lend on short-term basis. In this market, company can borrow or lend on short-term basis so as to fix the interest so as to fix the exchange rates for future transaction. At the money markets, you can borrow or lend so as to fix the exchange rates between the two currencies. If you are dealing with international transactions, if you are dealing with foreign transactions, there are two possibilities. It is either you are making payment in foreign currency or you are expecting inflows in foreign currency. Let me repeat that. For foreign transaction, it is either we are making payments or we are expecting receipts. Given this scenario, we can describe how to deal with foreign payments or foreign receipts. If you are making payments in foreign currency, that will represent a foreign liability. If you are making payment in foreign currency, that will represent a foreign liability. To hedge using money markets, we are going to create an equivalent foreign asset. Alternatively, if you are expecting inflows in foreign currency at future period, that foreign inflows to you is an asset to the business. To hedge using money markets, we are going to create an equivalent foreign liability. So you can use money market to create hedging around foreign currency risk. Normally, once I finish explaining money markets, I like to put question to it. But with these 15 minutes remaining, you cannot address any question again. But please note, for money market hedging, it is either you are borrowing money to hedge, or you are lending, or you are making investments. All right. Number 3, currency futures markets. Currency futures markets. We have explained forward exchange contracts, also known as forward markets. We have explained money market hedging. Number 3, currency futures contracts. Currency futures contracts is an agreement between two parties. A currency futures contract is an agreement between two parties to buy or sell a specified amount of foreign currency. To buy or sell a specified amount of foreign currency. At a fixed purchase price. The currency futures deals are in the form of a standardized contract and available only in limited range of currencies. The currency futures contracts are available only in limited foreign currency. Only in limited foreign currency and for a limited range of 4 time period. The currencies that can operate in this market, the currencies that can operate at stock markets or at the currency futures markets are United States dollar, Canadian dollar, Australian dollar, British pound sterling, euro, Japanese yen, and Switzerland currency. These are the 7 currencies that can operate as currency futures markets. These are the currencies that are recognized as the currency futures markets. Next. Steps involved when using currency futures for hedging. Steps involved when using currency futures contracts. Step 1, determine the target outcome, what you are trying to achieve. What we are trying to achieve is to avoid fluctuation. Fluctuation in exchange rates. So your step 1, determine the exchange rates. Sorry, determine the target outcome. Next, do we buy or sell futures now? Will the company buy futures or sell futures? Which expiring date should be used? In your step 1, you must address 4 questions. So don't forget, calculate number of contracts needed. These 4 questions must be answered in step 1. Determine the target outcome. Do we sell or buy futures? How many contracts needed? What expiring dates? Or which contract expiring dates to be selected? When you are done step 2, contact the exchange and pay the initial margin. In most cases, there is no margin involved. Step number 3, determine the profit or loss. Profit or loss in the futures market. By closing out the futures contracts. For you to determine the profit or loss, by closing out the futures contracts, there must be opening futures price and closing futures price. For you to evaluate result of your hedging, there must be closing futures price and opening futures price. Where closing futures price is not given, the opening futures price is always available. The opening futures price is usually available, but the closing futures price may not be given. Where you are not giving the closing futures price, then you are going to estimate the closing futures price. How do we estimate closing futures price? If you are not giving closing futures price, how can we estimate the closing futures price? Let me use estimating the closing futures price. Although it's here, look at it. To estimate closing futures price, we make use of the concept of basis. Your basis is spot price minus opening futures price. Your basis is equal to spot price minus opening futures price. Next, separate the basis into expired and unexpired basis. Separate your basis into expired and unexpired basis. Then the last step, calculate closing futures price. Calculate your closing futures price as opening futures price plus unexpired basis. Your closing futures price is estimated as opening futures price plus unexpired basis. Please note, the estimated closing futures price becomes the lock-in exchange rate for that transaction, for that future transaction. Currency options. Currency options unlike forward markets, forward exchange contracts, and currency futures contracts that are binding hedging tools. That are binding hedging tools or instruments. The currency option can be used to protect a company against adverse movement in exchange rates, against adverse movement in exchange rates, while at the same time you can take advantage of favorable movement in exchange rates. It says currency option. It allows a company to protect itself against adverse movement in exchange. At the same time, you can take advantage of favorable movement in exchange rates. Because of these benefits, Hedging with currency option is more expensive than hedging with other methods. Number 4, currency options. Our currency options, there are 2 types of currency options. There are 2 types of currency options. We have over-the-counter currency option. That is number 1. Number 2, exchange traded currency option. Number 1 is over-the-counter currency option. Number 2 is exchange traded currency option. Over-the-counter currency option is very similar to forward contracts. These options are tailor-made to fit the company's precise requirements. Currency options, over-the-counter currency options, are tailor-made to fit a company specific or precise requirements. Number 2, exchange traded currency option. These options are similar in many ways to currency futures. Exchange traded currency option is similar to futures contracts in that they are available only in limited currencies, limited range of currencies. These currencies are United States dollar, Canadian dollar, Australian dollar, British pound sterling, euro, Japanese yen, and Switzerland currency. With a standardized amount of money per contract. The contract is standardized and with a limited range of forward time periods. At this market, all contracts are for 3 years. Let's round up this. Steps involved when hedging with exchange traded currency option. Step 1, you are going to address the following 4 questions in step 1. Set up your hedging by addressing the following 4 questions. 1, do we need call or put option? 2, how many contracts do we require? 3, which exercise price or exercise dates to use? And next, which exercise price to use? Step number 2, contact the exchange and pay the premium. Next, on the actual transaction days, compare the exercise price with the spot exchange rates on the actual transaction days. So as to determine whether to exercise the right or not. You are going to compare the exercise price with the spot rates so as to determine whether to exercise your right or not. If the spot rate is not given, if on the transaction date the spot rate is not given, we can assume that the option will be exercised at the exercise rate. All right. The last one is currency swap. Currency swap. Currency swap is a contract between two parties to swap equivalent amount of foreign currency. To swap equivalent amount of one currency at an agreed swap rate over agreed credit period. Currency swap. Contract between two parties to swap equivalent amount of currency at an agreed swap rate between the parties. We can also explain currency swap as a contractual agreement between two parties to exchange the principal amount of loan and interest in one currency for another principal amount of loan and interest in another currency. That is currency swap. Any question, please? No step is involved here. In currency swap, you are swapping currency at an agreed swap rate. Any question, please? Swap, currency swap, an agreement between two parties to swap currency at an agreed swap rate over the credit period. For example, I have my investments, I place investments in South Africa. I want to invest in a project in South Africa. I will go with my Naira in year 0. I'm going to convert Naira to Rand. I will place the investment in South Africa. Annually, I will get return on investment. We said currency swap, an agreement between two parties to swap equivalent amount of currency at an agreed swap rate. The swap rate is agreed between the two parties. Of course, I didn't even plan to finish it tonight. We are done with the explanation. We shall stop here, obviously. We can't take any question tonight. But I will encourage us to watch the video as many times as you can, because all the explanation has been done. What remains is to start putting questions to it. May God give us a better understanding. Any question? I need to check out of this classroom.